Well, you mentioned the run-up in the markets in 2023. I mean, a lot of it's been driven by large cap tech / sort of digital stocks, the so-called Magnificent Seven. The portfolios or the strategies have definitely been a beneficiary of that in 2023. Can that run continue?
We own, I think, 6 of the Magnificent Seven. I think understanding how long we've owned them is important. Alphabet, Microsoft, Amazon, we've owned since 2006. We've owned Meta is another Magnificent Seven. We've owned them since the IPO nonstop in 2012. What are the other Magnificent Sevens?
We've got NVIDIA.
Oh, NVIDIA we bought in January of 2019. So again, not a new purchase. So the Tesla is the newest one, which we bought last year. So our benefiting from the run-up today has nothing to do with anything we did in 2023. It has everything to do with our long-term focus, our ability to execute on the discipline of owning only high-quality structural growth companies at a discount to intrinsic value. Last year, classic example, there was a big drawdown in the market, but there were also idiosyncratic concerns around Meta. They'd spent $40 billion on the metaverse. Investors were very unhappy, not just because of the sell-off and the bursting of the bubble from the work from home, but they sold off Meta for this, idiosyncratic reason. And in doing so, they took $700 billion off of the market cap for a $40 billion expenditure. That's a classic overreaction. It doesn't change the long-term ultimate intrinsic value for Meta. So we took advantage and we added to Meta in every quarter of last year.
To what extent are some of these investments actual companies you're investing in? To what extent are you backing individuals? You mentioned Meta, you mentioned Tesla. Some of these have got A shares, B shares, different voting rights. How does that, how do you make sure you're not actually hitching everything to the sort of the skills and outlook of one individual, which might work very well in some conditions, but very, very badly in others?
It definitely has to be looked in the full context of the business and all of the criteria that we're looking for. But generally speaking, we really like founder-led businesses. Founders generally are the largest shareholders, and they have a long-term vested interest in creating shareholder value because they are a shareholder. So we think that's actually a positive, generally speaking. We look at the manager as a manager. What is their business objective? What is their business skill? And how are they leading the company? And so we will look at it in the context of the company, but we actually think it's generally a good thing.
But whenever the Romans did a triumph, there was always a slave behind the general whispering in his ear to remind him he was mortal. I mean, do you sort of want to make sure that somebody who's keeping these very high-powered executives' feet firmly on the ground?
Well, it's important that they have a good team around them, so we don't just look at the owner, we look at the board and we look at the other key managers. That's very important. Essentially, you're asking about key man risk.
Yeah.
If you can get key man risk, take it, right? I mean, there is risk there, but they're key people for a reason. The vision and the skill and the ability to execute is extraordinary. Say what you will about the leader of Tesla, but he's an extraordinary businessman. And when you look at our investment time horizon, everything that we need to have our investment thesis realized is already in place. They just opened up 2 new gigafactories last year, which are far from at capacity. So what we need to have produced in terms of automobiles over our long-term investment time horizon, that's already happened. You're talking about management teams that think in terms of decades. They're busy planning for the next 10 years, not the coming 10 years.
So if he's having issues with Twitter/X, if he's spending quite a lot of his time popping around the Middle East, you're quite relaxed about that because your argument would be all the things he has in place to make Tesla a success are already there regardless of him.
I would say we're vigilant to everything all the time.
Well, we talked a lot about technology, but what are some of the opportunities and these long-term structural growth opportunities you see outside of that big tech sector?
It's I think it's important to talk about how we think about sectors. Because valuation drives all of our investment decisions and the discount to intrinsic value drives the position size, Our sector weights are purely the byproduct of bottom-up stock selection. One of the things that we do, which I would also describe as structural, is our approach to risk. We have a permanent and structural approach to risk, meaning we don't look at the world and say today is risk on or today is risk off. The risks that we're talking about today are priced into the market. What's going to get us is the risks that are unknowable, and by their very nature, we can't forecast them. But they're inevitable. There are going to be macro changes. There are going to be geopolitical sensitivities. There are going to be changes in leadership in different countries. Those are inevitable. You just can't predict the outcomes or the timing or the magnitude of those things. So we want to be ready every day. That's why we own the companies we own. That's why a discount to intrinsic value, creating a margin of safety, has us ready for whatever can come. The other thing we do is diversify by business drivers, right? So we're not diversified necessarily by sectors in the traditional way, but we look at the drivers of growth. So a business driver for us is the driver of growth in our model that has the largest impact on our estimate of intrinsic value. And we want to make sure we're diversified across a lot of different business drivers so that there's no correlation among them. There's more than 25 business drivers in the large cap growth portfolio that has about 35 names. So if you look at those tech companies, we have a lot of different business drivers, right? So Amazon is driven by e-commerce. Oracle is driven by enterprise IT. You can look at another part of Amazon that's cloud infrastructure. NVIDIA is spending on GPUs for gaming and AI. So they're all technology, but they're all driven by different growth drivers.